Hello, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. You are tuned into On Trend, and today we're going to talk about breadth and other stuff. Thanks very much for tuning in. I'd like to welcome our host, Zach Dillon, to the show. Zach?
Well, I'm not sure I'm the host of the show. I think you are. I'm just here to go ahead and answer or take questions. But
You're right, the producer. You're the boss of the show, Zach.
Yeah, something like that. How are you doing, Arthur?
I'm doing very good.
Awesome. Well, we just wanted to direct your guys' attention over to the questions and poll tab over on the right-hand side of the video player. If you want to ask Arthur any questions during the show, feel free to put your questions in. Make sure you put your name, and if you would like Arthur potentially to go ahead and get back to you through email, make sure you enter all that information as well. No promises, though. Arthur's a busy guy, but sometimes it does help. So, all right, Arthur, that's it. Go for it.
All right. Thanks very much, Zach. Yeah, please submit your questions. Try to keep them relevant to the show topics or at a higher level. In other words, I'm not going to do individual stocks for this show or individual ETFs. So looking at today's agenda, we're going to start with some breadth indicators. We're going to look at the 80 line, 80 volume line, HighLow indicators. And then we're going to look at the swings within patterns. And this is a way I use to kind of anticipate a breakout on a bigger times frame. And I'll show you how that works with the S&P 500 and some other sector examples. Then we're going to break down the tech sector. And so it's really just some stinky socks that are weighing on the tech sector. The other parts of the tech sector are doing just fine. And we'll finish with some stocks to watch. So here are the AD lines, and I've got 4 on this chart, and it kind of goes in a top-down fashion. At the very top, you're going to see the AD line for the S&P 1500, and this is like the broad market AD line because it covers everything. It has the S&P 500, large caps, S&P 400, mid cap, 400 mid caps, S&P small cap 600. Altogether, you've got the S&P 1500. So it's one of my favorite indexes to use for a breadth indicator. And then at the bottom, I've got the NASDAQ 100 AD line, just as kind of reference. There are about 85 stocks from the NASDAQ 100 in the S&P 500, by the way. But if we look at these AD lines, we can see there's broad strength in the market as a whole. If you look at this S&P 1500 AD line, a new high in January, a new high in March, and there at the top right of the chart, a new high here in April. Now, you see the S&P 500 is not keeping pace. It's been weighed down by some large caps because small caps have taken the lead recently. And if we look at the AD line itself for the S&P 500, though, it did hit a new high here. So we've still got internal strength in the S&P 500. We have a new high in the AD line for the S&P Mid Cap 400, as well as the Small Cap 600. The only AD line that did not hit a 52-week high is the NASDAQ 100. And so that is because we've been seeing some weakness within the technology sector, but I think it's really concentrated in semiconductors and a few other stocks maybe related to Apple. Now, the AD volume lines are a bit different. The AD line, each stock is treated equal. So if you have Apple with the largest market cap and you have a small airline like Delta Airlines, an advance counts as +1 regardless of market cap. So Apple and Delta are on the same level. But when it comes to volume, Apple is going to have a lot more volume. So when it goes up, its volume is going to count a lot more than, say, when Delta goes up or a smaller stock that trades a lot less volume. So I think the AD volume lines better reflect what's happening with large caps. And we can see that when we look here. This is the S&P 1500 AD volume line. Okay, it hit new highs, so it's doing okay. But here we have the S&P 500 AD volume line, and it did not hit a new high. And that tells you that there is some weakness in the up volume as far as up volume relative to down volume. And I do prefer to use this AD volume line as opposed to exchange volume. Not a big fan of using exchange volume, on balance volume, the accumulation distribution line, or volume indicators. I'll use them for individual stocks, but not for ETFs or exchanges. And if you're wondering, go back and just look at volume and rallies, and you're going to see plenty of low volume rallies out there. It happens. So looking at mid caps, didn't hit a new high either. Small caps hit a new high. So we're getting more participation in small caps. And the NASDAQ AD volume line did not hit a new high. So we're seeing some relative weakness in large caps. Now we've got some high-low pairs, and this is a really nice way to show the high-low indicators. Again, we've got the S&P 500, S&P Mid-Cap 400, S&P Small-Cap 600. And what's happened here is we've kind of gone into a holding pattern where we're not getting enough new highs to get a liftoff in the S&P 500. You can see we've just been moving between, say, minus 40 or 40 on the new lows and maybe 40 on the new highs. And we need to get above 50 on the new highs to start getting broad enough leadership in the market to really get the S&P 500 moving higher. And you can see small caps, this line here is at 60 for small caps, and it's at 40 for mid caps. And the reason it's there is because that's kind of the 10% line. 40 is 10% of 400. Minus 40 is when new lows dip below here. That would be like in February, you had more than 40 new lows there, but that was countered with more new highs in March. But you can see, even though we're getting more new highs than new lows, that's net bullish. We're not getting enough critical mass yet. We haven't seen an expansion of this advance, and that's probably why we're locked in a trading range. And I'm just going to go ahead and click on this chart so you can see it. And I'm going to show you the settings down below if you want to recreate it for yourself. There you can see the indicators, explanation point, new high SPX, explanation point, new low SPX. And then to create that, you would do a price up-down pair as an indicator here. And then you would add the two symbols separated by a comma. And it'll put the first one in the positive and the second one in the negative. So you have new highs first and new lows second. And then I added a horizontal line there as an overlay, which you can do by opening the advanced functions. So this is a nice chart, and I check it at least once a week. It's kind of a longer term breadth indicator, but I would like to see these new highs exceed the 10% level for all of these to get this rally going back on the upside in the S&P 500. So what about the S&P 500? Well, what we've got here is we've got swings within patterns. And this is what I'm going to show with the S&P 500 and the 5 big sectors after this. So the big pattern is the triangle. And so basically you have a long-term uptrend because you're hitting 52-week highs as you're going up here in September, October, November, December. And then boom, you get hit hard and you bounce, and you get hit and you bounce. So we're locked within this trading range. And typically a consolidation after an advance or within an uptrend is like a rest. And remember, you had a massive advance since the election all the way to January 2018. So that's over a year. And so a big advance deserves a big correction. And it looks like that's what we're getting here, is a big corrective triangle. And if it is a correction, you expect a breakout and a move to new highs eventually. And that's why I put in the poll. The question for today is, do you expect the S&P 500 to hit a new 52-week high first, or to break its 2018 lows first, or to just stay in this trading range? And it is a big trading range, extending up to 28.75 and down to 25.75. That's about a 300-point range. So what do you do when you're in this kind of a range? Well, what I do is I focus on the swings within the range. And mostly I focus on the bullish swings. And that is for the simple reason that I want to stay on trend. In other words, the long-term trend is up, and I want to stay in line with that trend. So I want to look for bullish setups. Sure, you can play a good decline like this one if you can catch it, but I'm more apt to look for something that's in harmony with the bigger trend. So I don't have the triangle drawn here, but you know what it looks like. And there's the downswing, there's the upswing, there's the downswing. And about 3 weeks ago, we started an upswing. So I think there are 3 stages to this reversal here. You have kind of the bottom picking phase where you start to firm and momentum oscillators become oversold. And then you have the breakout phase, which happened here in the second week, third week of April. And now we have the monitoring phase where we monitor the trend and we set our levels to see what it would take to prove this advance otherwise. What would it take to reverse this advance? And so I'm bullish on the long term and the short term. And I've got my support level marked with a Roth regression channel here. Because, yeah, I could draw a trend line, but I'm not that big of a fan of angled trend lines. And the Roth channel extends from the closing low here in early April to the closing high here last week. And that lower line comes in around 265. And then you got like 3 lows here around 263, 264. And of course, we take a combination and we have a support zone around 263, 265. And so we've had a little pullback, and this could give way to a bounce. And I think as long as this support holds, I would expect higher prices and a challenge to a bigger resistance zone from these February, March highs. If we break down here, then all bets are off. And it's very important that we watch, I think, that we watch the S&P 500 first and foremost, because it is the leader in the market as far as, it's the largest index, as far as it counts for 80% of the total US stock market. It's the most widely followed benchmark. And so if it goes down, I think small caps, mid caps, large techs are going to go down with it. So that's why if the S&P 500 SPDR breaks down here, I would turn quite negative on the market. So let's look at the 5 big sectors. And the reason I chose these sectors is because together, these 5 sectors, remember there are 10 sectors, sector SPDRs. Well, 5 of them account for 75% of the S&P 500 SPDR SPY. So they account for the lion's share of the stock market. And so that's why I would focus on those 5 when it comes close, when it comes to calling the broad market trend, see how these 5 are doing. And as long as these 5 are in upswings, I think that there's a good chance that the S&P 500 remains in an upswing. If, say, 3 of the 5 break down, then I would say that the market, S&P 500, is probably going to break down. So if we look at consumer discretionary, there's that triangle like we had before. And there's the downswing. Here's the upswing. And you have a little pennant in between. And you got some lows around 101 and a Roth channel. So there's a support zone there to watch. Here's the technology SPDR. Now, it's still in an uptrend. So you can see this very sharp decline, but it's after a 52-week high. You're holding above this prior low. And then you've got a breakout here. And now we've got a little throwback, and that's mostly because of semiconductors, as I'll show. But broken resistance turns into first support. So this is an area to expect a bounce in technology. If we break down here, then that's going to be +1 for the bears. Right now, it's +5 for the bulls. Here is financials, and they're getting a nice boost today. All right, they have a big falling wedge. And somebody's asking, what would it take to declare the correction over? Well, to technically declare the correction over, you'd have to fully reverse this decline here. And that means you have to break out here. But your risk to reward ratio is not going to be that great up there. and the market's been very volatile. And so that's why I'm focusing on the swings within these bigger correction patterns. And so that kind of gives you the jump on a potential breakout. You have to decide, do I want to turn bullish down here, or do I want to turn bullish up here when we break above these highs? And you have to decide that ahead of time. You know, you don't want to wait and get caught kind of in a no man's land around 29. So there's a clear upswing here. I couldn't draw a Roth regression channel. Trend lines didn't match up. I can't draw a nice trend line here because the lows don't match up, but you can see a nice choppy advance. It's actually not that nice. It's kind of choppy right here, but it is a bounce. All right. So this is a 52-week high back here in January. So that tells me the long-term trend is up. And so now we're getting a bounce here. And so this might be an opportunity to anticipate a bigger breakout and a 52-week high later in the year, in a couple months in finance. Last week, I talked about bonds, and bonds broke down. So here's industrials, and industrials are kind of dragging their feet because they were kind of late to break out. You can see this breakout didn't happen until last week, and now we're pulling back, but it looks like a flag here. So you have like a sharp advance, and you're up above resistance here, and you got first support. So we got a little flag. And if we can get a flag breakout there, that opens a door for industrials to move higher. Here's healthcare. Now, healthcare, I didn't draw a triangle and I didn't draw a wedge because I just didn't like the way these trend lines were setting up. It just didn't look right. I draw trend lines to mark patterns. I don't really like to use them for support and resistance levels. But, you know, there's a downswing, and the downswing reversed with that breakout and a little throwback. So this resistance turns support. So this is a place to watch. And if you break below 81, then you reverse this upswing. So until 3 of these 5 sectors reverse their upswings, I think the sum of the parts is net bullish for the S&P 500 and hence the broader market. All right, now we move on to a new page and a new section. We're going to focus on technology. And one thing I like to do is I like to break down a sector, if I can, into its component industry groups. You can't do that so easily with every sector, but you can do it with ETFs in the technology sector. And what I pointed out a week and a half ago in the weekly market review and outlook was you had breakouts. Yeah. Oh, sorry. I thought you were calling me there, Zach. You had breakouts here in the technology SPDR, in the internet ETF, FDN, in the software ETF, IGV, in the cloud computing ETF, in the semiconductor ETF, but it has failed. All right. And the other ones I just showed you, their breakouts have not failed. Okay. Semiconductors, definitely the weakest of the 5 here of the industry groups. So stay away from them. There are better places to be. And hack is the strongest of all right now. Its last signal there was early in April with that flag breakout. I usually don't pick stuff up at new highs. It's more informational when you're at a new high. The actionable information is when you get the breakout here. So I did the same thing with these industry groups. I put some Roth regression channels and I marked some support levels. And as long as the majority of these industry groups hold up, then technology is doing just fine. Sure, the SOX is stinking things up and going down and weighing on technology, but you haven't gotten a follow through or a reversal from the other 4. So here's cloud computing. 49 is the level to watch. Hack, I don't have a level to watch really because it's at a 52-week high. For internet, and Facebook reports soon, so that will be affecting this one at some point. But there's the level to watch around 120 or so. You can see broken resistance turns support in the Roth channel, so it's a zone. I like to use zones when it comes to support and resistance for ETFs because they have dozens of moving parts. Here's IGN networking. There's a bounce. There's support at 51.5, 52. So it's doing fine. And semiconductors, stocks, there's a failed breakout under pressure again today. Looks like it's heading for a test of these lows from November, February here. And software, there you can see that bounce and then support here. So, you know, they're looking a little heavy maybe, but they haven't broken down yet. Watch for the breakdowns to take down the technology sector. So I thought I would look at the Fab Five, as I call them, because one of them looks different than the others, and that is Facebook. The Facebook chart still looks broken to me, all right? And it looked broken when you had the lower high in this breakdown here. All right, it's bounced back, and you can see kind of a support around 170 would turn into resistance. You have a death cross there with the 50 crossing below the 200, and the stock is below the 50 and the 200. So pass, move on to the next stock. This one is not worth looking at. All right. We look at Google. It was looking like it wanted to break above its 50-day, but now it's filled this gap and it's threatening its 200-day. So it's on the verge of turning down. Apple is right at its 200-day. So these two are looking iffy. Facebook is out of the question. Just move on, pass, look for other options. The two strongest are still Amazon and Microsoft. They're well above the 200-day, both of them. And Amazon is at its 50-day, okay, but Microsoft is above its 50-day and near a 52-week high. So these are the ones that are still holding up and showing the most strength right now of these big technology stocks. So this is kind of a chart of interest, but I noticed that Treasury yields around the world in US, UK, Germany, and Japan are all on the rise. Now you can barely see the rise in Japan, but there is a rise, and it did take a sharp upturn over the past week and a half or so. And the German 10-year moved up. The UK 10-year has been moving up since early April, and the US 10-year hit 3% today. This is a close-only end-of-day chart, but Treasury yields are on the rise, and I think that's a positive for the finance sector and banks and brokers. Notice that Charles Schwab is near a 52-week high. E-Trade Financial, I believe, hit a 52-week high last week, and Interactive Brokers hit a 52-week high, and TD Ameritrade is near a 52-week high. So this is positive for brokers. I think it's negative for utilities and REITs and other interest rate sensitive issues. So I got a few stocks to run through for you that might pique your interest. The first is Delta Airlines, and 50 days above the 200-day, hit a 52-week high here. So that tells me I'm on trend. All right, the trend is up. I want to look for bullish setups. So we can see a higher low forming from February to April and a little breakout there. So it looks like Delta wants to move higher. I think that's the most important thing, is look at the chart and decide if the long-term trend is up. If it's not, pass, move on. There are other charts that look better out there, I'm sure. Here's Bank of America. It hit a 52-week high in March. The S&P 500 did not hit a 52-week high in March. So by default there, it's showing relative chart strength. It's testing support here. Maybe this is a bear flag, but it's rising. The long-term trend is up. The short-term trend is up. I would say this is going to challenge its 52-week high sooner rather than later. If you break 29.5, okay, then you reevaluate. You put your line in the sand ahead of time. You plan your trade and you trade your plan, basically. Here is Nike. Nike's another example of a pattern within a pattern. All right, the bigger picture is bullish, a big advance here. a big triangle, and you expect a breakout and a 52-week high. Now, within the pattern, you have this surge and what looks like a flag of sorts, and you're trying to break above that trend line and move higher. So the internal breakout would argue for a bigger breakout at 70. Here is UnitedHealth, and this one already had a breakout, has a 52-week high here. And by the way, I tried to find stocks that were not reporting earnings in the next week or two. Don't even want to mess with an earnings report for a new position. But this triangle here is a bullish continuation pattern because the long-term trend is up. We've broken out with a gap, and now it looks like a little flag working here. So you could put on a 30 or 60-minute chart to watch this range and this flag and look for a flag breakout that would open the door to new highs. Google, well, I was looking positive on Google before the open, but now it looks like it's about to break support. It's right at support, so this is a big test. And if we break 2030 on a closing basis, that will be negative for Google. And that is it for the presentation chart portion, excuse me. I'm going to turn it over to Zach and see if we got any questions.
Well, we had 2 questions. One was about an individual stock, and I know you said you didn't really want to mess with that too much. I'll put it in your ball court. It's about BP. It's doing a stair-step advance. They're just wondering if you see a good exit point.
No, I'm going to pass, please.
Okay. And then the next one is there a way to download any of the Arts Charts list from the weekly video annotations?
So when you get a chart that has annotations on it and you want to save it to your chart list, I believe you have to click on that chart. So say if I wanted to save this chart from somebody else's chart list, I would click on it and I would go to the annotate button. All right. And I would click annotate and I would just add one annotation. It doesn't matter what. And I would have to click save as. And I can't do it because this is my own chart list. I'd have to do it from somebody else's chart list. But then when you close it, you would save it and you would save it to one of your chart lists. And I believe the annotations would stay with you.
I think also, though, I think the question is asking, is there a place they can find these charts that you're presenting?
Yes, there is. If you go to the top, you can see the blog articles tab. And if you go to Arch Charts here, click on the Arch Charts, that will take you to the homepage for Arch Charts. And every week on Friday, I update my chart list. And I put a link into that updated chart list. And the link is usually at the bottom because I also put notes in on specific ETFs. There are 30 ETFs in this chart list. All right. And so you can see I've made some notes on these particular ETFs. And the title is linked to the Arch Charts chart list. So if you click on that, there you can see last updated February 20th. And there is home construction. And since we're on it, we got a few seconds.
Arthur.
What's that?
Scroll back up. That's April 20th.
Oh, April 20th.
April 20th. Friday, April 20th. That might have thrown you off a little bit.
Okay. Yeah, sometimes, the mind gets ahead of the mouth. And
no worries.
So anyhow, ITB is bouncing off support here. That's on the chart list. But we are running out of time. And I would like to thank everybody for tuning in and just remind you to stay on trend. And I'll talk to you next week.